Hello everyone and welcome. My name's Elliot Gu. I'm the co-founder of the Capitalist Times Investment Research and of the CT Commodities trading service. Now you may or may not have heard of me or my firm, but I've actually been in this business for almost a quarter century now. I started out back in the late 90s. In the early 2000s, I actually created one of the largest energy-focused investment services covering oil, natural gas, coal, other related commodities. Then about 11 years ago, I left to start my own firm with a colleague, Roger Conrad, who you may know, called Capitalist Times, where I've continued to focus on energy stocks, energy commodities, and of course other commodities. So I've always had a little bit of a specialization in the commodity markets. Now, those of you who do know who I am or have read or subscribed to some of my services know that most of the work I do is longer term in nature. So we're really focused on investing in energy stocks and investing in big themes over time in energy markets and other commodity markets. However, obviously as part of that research, I spend a lot of time analyzing and looking at individual commodities on a shorter term basis. You can't imagine how many times over the years, both from my readers as well as on television interviews on the radio, podcasts, etc., in person at conferences, how many people ask me where I think oil or natural gas or gold is going over the next few weeks or the next few months, or what I think about a fairly speculative or smaller company that's involved in one of these industry groups. And this is something I do follow. I cover dozens of companies involved in the energy and other commodity sectors. And of course, I follow the commodities very closely. And at a recent trip just last week to the Orlando Money Show in Orlando, Florida, I got asked more about short-term investing in energy than I had in a while. And I'm always surprised how much interest there is. And so what I want to talk to you about today is my CT Commodities trading service, which is kind of unique among the services I publish in that it is a service geared towards shorter term moves, swing trades if you will, in commodities. Now, not commodity futures, we recommend trades in commodity related ETFs, exchange traded funds. So these would be things like USO, the US Oil Fund, which tracks West Texas Intermediate oil prices, or UNG, for example, that tracks US natural gas prices. I'll talk a little bit more about that here in just a moment, as well as related stocks, energy producers, oil services firms, mining companies that are involved in precious metals or copper or any other kind of mine. Even agricultural commodities. We actually do have a trade out there right now in a company involved in the fertilizer industry. So the focus of this service is on more short to intermediate term trades, if you will, over time. And I've been asked about this so much, I decided to create this video totally unscripted, although I do have a few slides to show you today, covering how I look at shorter term trading in commodities, what I look for in a stock if I'm looking to potentially make money over the next few weeks or few months rather than over a period of many years, how we look at timing or entry and exit recommendations in the CT Trader Commodities service. And in particular, I want to look at a trade we recently closed in the service. I believe we actually finally closed the trade all out on October 18th of this year. It's in a company called Southwestern Energy. The symbol there is SWN. They're a US natural gas producer. I'll tell you more about them in a moment. And we took a gain of $2,150 in this trade. Now, that doesn't mean much to you because I didn't tell you how much we put into the trade, but in actuality, we first recommended the stock back in early February of this year. So this trade was open a little over 8 months, though we were in and out of the stock a little bit over that time, as I'll explain to you. And our original capital required to get into this trade, we recommended readers get 1,000 shares, which would have cost you a little over $5,000 because the stock was trading around a little over $5 a share back in early February. And again, we sold out for about a $2,150 profit, which is upwards of 45% gain on this trade. So I want to tell you a little bit of how we did that, a little bit of what we look for, as well as why I just recommended, literally just last week here in early November, getting back into Southwestern Energy. how I recommended getting back in, why I recommended getting back in, what I see ahead, and some of the ways we go about managing risk. So quite a lot to cover. I'm going to try to be as quick as possible. And again, this is unscripted, so I'm going to just follow along with some slides I have for you today. So let's start with this first slide here. And this is actually a topic that, again, attracted a lot of attention when I was speaking in Orlando last week. And this is simply a chart of front-month U.S. natural gas prices priced at Henry Hub, Louisiana, which is a trading point for gas. And I took this chart all the way back to early 2018 up to the present time. And some of you who do follow this market to some degree might even be familiar with the trading action in gas over the last several years. Now again, this is the front-month futures contract. And so back in 2018, it was trading around $2.50 to $3 a million BTUs. In early 2020, during the coronavirus lockdown recession, it traded well under $2 a million BTUs, which is a multi-decade low for U.S. natural gas. Coming out of that crash, right, we had a big bull market in natural gas, which came to an end in 2022, with gas trading upwards of $10 a million BTU intraday. I think the highest close was around $9.80 or $9.90 a million BTUs. Now again, you can see that on this chart, but you can also see what happened since then. Gas prices crashed all the way back under $2 a million BTUs in the spring of 2023, and they've since recovered to around $3.25 to $3.50. Now, as I said, you probably are, if you follow the natural gas markets, if you're an investor in energy stocks on a longer term basis, for example, you may be intimately familiar with how gas has traded over the last couple of years, and it's been a wild ride. But what I'm going to tell you might actually surprise you. Gas has actually been a lot less volatile than you think. And the chart I just showed you, while again, you probably, if you turn on the news, they would tell you that gas has been under 2 to over 10 in just the last few years. That chart I just showed you is actually completely irrelevant for most energy producers, most natural gas producers. Now, I know that sounds a little shocking, but let me explain here over the next few slides. So the next slide I wanted to show you here is actually just a close-up of front-month natural gas prices this year. And again, I kind of showed you on a longer-term slide there, but you can see at the beginning of 2023, gas prices were over $4 a million BTUs. They collapsed to a low of around 2, either side of 2, in February and March of this year. The actual low was late March of this year, under 2. And as I said, now we're back up around $3.25 to $3.50. So again, if a lot of people ask me at the show and always ask me, why have gas prices gone up so much since March, from under 2 to over $3.25? And what I like to tell them is gas prices have barely budged since the late March lows. Now I know that doesn't seem to make any sense whatsoever, but hopefully I can explain it to you with this next slide here. Now I think this is maybe one of the most important slides to understand if you really want to understand how the U.S. natural gas market works. The front month futures price is generally just the price of gas for delivery in the short term. So, if we're trading, say, December futures right now, it would be gas for delivery next month in December 2023. Back in March, it was probably the March futures, or back in March, it was probably the April futures we were looking at, or the March futures, which were trading, as I said, again, around a little under 2 or a little over $2 a million BTUs. However, there are other forces at work. First of all, gas prices, there are futures for gas that trade for every month of every year for years into the future. Now on this slide, I'm actually showing you the curve, the futures curve, on 3 different dates in the past for gas for delivery out through the fall of 2028, so about 5 years from now. And in addition to that, gas is a seasonal commodity. Now, what do I mean by that? Well, yes, a lot of gas is used in the summer to produce electricity and run air conditioners, but summer demand for gas is much lower than wintertime demand for gas. Heating season particularly the months of sort of late December through early March, are pretty much it for natural gas in terms of demand. That's the peak demand of the year. And typically, if you look at this chart, you'll see that sort of wave action in the futures curve, right? So what that is it's the seasonal effect. So gas prices are going to tend to be lower for delivery in a time of year where demand is low, like for example, in early October or October of every year when, cooling season for most of the country, though not so much down here in Florida, is already over, but heating season hasn't gotten started. Or say, early May or April or May of in the spring, where prices, temperatures, if you will, have already climbed to a level where people aren't using as much heat, but at the same time, they're not having to cool their homes that much yet. So there is a seasonal effect, but as you can also see from these three different curves on different dates, there's also longer term forces at work. So I want you to look at that blue curve. Now that blue curve, that blue line on the chart, is actually the natural gas futures curve. This is the price of gas for delivery starting in June of 2020. The futures that were trading back at this, I took this snapshot at the end of April, but we're looking at the price of gas for delivery in June of 2020 all the way through September of 2028. So you can see in April of 2020, the June futures were trading a little under $2 a million BTUs. If you looked out to January of 2021, the futures were trading a little over $3 a million BTUs. But so there was that normal seasonal impact as wintertime futures were trading at a higher price. But look at that curve going out to 2028. It's flat as a pancake, right? You could have contracted back then for gas for delivery now at say, $2.25, or even out in 2025, 2026, the price curve was showing prices, bouncing around that $2.50 a million BTU range. Now fast forward and look at that gray curve, that gray line on the chart. Now that's the futures curve in this March, at the end of March 2023. And that was basically the lows for natural gas this year. Now if you look at that chart, the April futures for delivery in April of 2023 at the end of March, price at the end of March, we're trading around $2 a million BTUs, as I said earlier. And if you look out to the December-January 2023 part of that gray curve, you'll see that gas prices were trading around $3.75, a little under $4. But you can also see that the curve has a distinct broader upward slope to it, right? So unlike the 2020 curve, the March 2020 curve, flat as a pancake for years in the future at around $2.50 a million BTUs, that March 2023 curve was depressed on the front end, so very low front month, rose rapidly into this winter that's coming up, and then kind of had a gradual upward drift and kind of averaged between sort of $4 and $5 a million BTUs, right? From next winter, so a year from now, all the way up through 2028. And then I want you to look at the final line on my chart, which is that orange line, which is the present curve. I actually took this snapshot, I believe, right at the end of last week, so very early in November. And you'll see that the orange line and the gray line are almost identical, right? So back in March, right, in order to buy natural gas for delivery at this time, I would have had to have paid somewhere around that $3.25 to $3.50 range, which is exactly where gas prices are trading as we talk right now. So the price of gas, the expectations for gas, the outlook for the gas market really hasn't changed much between March and today. What has changed is only the front part of the curve. Now, as I said, back in March of 2023, prices were very depressed for immediate delivery in the spot market in the next few months out. But the price for delivery this fall, all the way through this coming winter, all the way through next year, through 2024, was broadly similar to the price for those same futures today. Curve is a very different shape to what we saw in 2020, but very similar shape to what we saw back in March. Now, what's the reason for this? Well, the main thing that you have to understand is that the natural gas market is heavily influenced by short-term weather-related factors and short-term supply and demand conditions when it comes to the very front of the curve. So last winter, right, was a very warm winter in the United States, also in Europe, and therefore heating demand was lower than normal. So as we came out of winter into the spring months, there was a lot of natural gas in storage here in the United States and prices were depressed. Low prices on the front end of the curve are the market's way of telling producers produce less natural gas. We don't have enough storage. We've already got too much gas in storage, right? So it's a way of incenting producers to cut capital spending and produce less natural gas. However, back in March and early April, the market recognized that things were likely to get better for natural gas in coming months, and there are a number of reasons for that. As I said, the warm winter of 2022-2023 was one reason why gas prices were depressed. Another major reason was a liquefied natural gas export facility in Texas called Freeport, LNG, that was offline due to a fire from June of 2022 up until the middle of March of this year, of 2023. And in total, because this plant was offline, the US basically lost out on around 400 billion cubic feet of cumulative natural gas exports. Guess how much US natural gas storage was oversupplied back in March, April? Yep, about 400 billion cubic feet. So virtually all of the glut of gas back in the spring was due just to the outage of that one LNG export facility. But the market knew back then, and what's actually happened since, is that Freeport was coming back online. It actually came back online in mid-March. In addition to that, already starting in their Q4 conference calls, which were mainly back in February, a lot of US natural gas producers were already talking about cutting back their drilling activity, cutting back their capital spending, because gas prices were too low for them to make money. So the market could already see supply coming down. Looking out a bit longer term, the US natural gas exports, right, in the form of liquefied natural gas, in order to make those exports, you need an LNG liquefaction terminal. So this is a terminal. This is a big facility. Most of them are on the US Gulf Coast, so states like Texas and Louisiana. You need a big export facility to handle exports of natural gas. And these take years to build and permit, etc. So right now, US liquefied natural gas capacity is pretty much maxed out. We're exporting as much natural gas as we possibly can, mainly because European gas prices are much higher than they are here in the US. In the second half of 2024, there are a number of new US LNG export facilities due to come on stream, including the Golden Pass terminal in Texas, the Plaquemine terminal, in Louisiana. And this will greatly increase US export capacity. Once again, there's a lot of demand for this gas. So those export facilities are going to be full. That implies a lot more demand for US natural gas and therefore higher prices. And you'll see, as I show you here on this slide, that the curve is centered out past the middle of next year, is centered around that $4 to $5 a million BTU trading range. The reason for that is that that's the price level of natural gas that's needed to incent production from fields like the Haynesville Shale of Louisiana, which I'll talk a little bit more about here in a minute. So in order to produce enough natural gas to supply these LNG terminals, the price of gas will need to be higher. So the market knew all of this that I'm telling you back in March, and they knew all of this, right, today, and it's actually happened in the case of the Freeport LNG. So though if you watch, financial television or some talking head on TV, they'll tell you the price of gas has soared. It's up by more than 50% since March. It's not actually true. The price of gas has pretty much followed the curve, that gray curve, which you could have looked at back in March, right? So the price of gas has recovered only because we can see that production is coming down as expected. These new sources of demand are coming on stream as expected. So one of the biggest mistakes I see a lot of investors make is they see the price of natural gas at 2. They listen to what I'm telling you about the price of gas being at 2 being too low for many producers in the US to make money, right? So obviously they're going to cut back their capital spending, cut back their rig counts, and supply is going to go down, and eventually that will act to push up prices. And so they think, well, why don't I just buy a commodity ETF like the US Natural Gas Fund, which trades under the symbol UNG on the New York Stock Exchange. This ETF is designed to track the price of natural gas itself. This company doesn't produce gas. It simply buys gas futures, actually, and tracks the price of gas. And a question I get a lot, or got a lot back in the spring, was, well, if gas is trading under 2 and you think it's going to 4, can I just buy UNG and double my money? The answer is absolutely you cannot. And again, I'll explain a little bit more about that in a moment. But first, let's move on to the next slide, and I'll show you how we actually do trade natural gas. So this slide here illustrates to you in the simplest form possible, I think, why what I just said isn't possible. Why, if gas is trading at under 2, right, back in February and March, or around 2, and now, as I told you, it's trading around 325 or 350. How come people haven't? Why can't you buy the U.S. Natural Gas Fund, that UNG ETF, and have your money go up by more than 50%, make a more than 50% return? As I said, the price of gas, 325, 350 now. Back in February, when we recommended buying SWN for this service, the price of gas was down in the low 2s, and right after that, just under 2. So why couldn't you buy UNG and make more than 50% of your money? I'll tell you, I've written articles many times in the past about this concept in basics, and I've had people argue with me. I've gotten hate mail from people over this concept. But the fact is that the U.S. Natural Gas Fund, you're not buying what you think you're buying. And so what this chart shows you is back on the day I recommended in CT Commodities Trader buying SWN, which is a U.S. natural gas producer, Southwestern Energy. What would have happened if you bought SWN and held to today versus buying that UNG ETF? And you can see here, even though the front month price of natural gas is more than 50% higher than where it was back on February 6th when we recommended SWN, the actual price of the UNG ETF is down 20%. So you wouldn't have made a 50% return, you would have made a 20% loss. And a lot of investors are shocked by this, and I'll explain in a moment why that happens. But first, look at what happened to SWN. In contrast, right, the price of SWN is up over this time frame, well over 35%. And as I said, at one point when we got out of it, we had a gain even higher than that. So what's the cause of this discrepancy between SWN and UNG, and why didn't UNG do better? Well, UNG doesn't buy physical natural gas. What they do is they buy those futures I just showed you. And then according to a preset roll schedule, they sell the front month futures and buy the next month out. And then they hold that for about a month, and then the next month they sell that contract and buy the next month out. So you're not really buying gas at 2, you're buying April futures at 2, waiting a month, buying May futures, which at that point we're trading more like 225 at a higher price. And then you're waiting another month and UNG is buying you, say, the May or June futures, which we're trading a little higher than that. And so each month you're selling a contract at a lower price, buying a contract at a higher price. So every time you roll, first of all, you're buying into natural gas trading at a higher price. So if you buy the April contract at 2 and then sell it a month later at a little bit higher, and then you buy the May contract at a much higher price, you're not still in gas at 2, you're now in gas at, say, 225 or 250. So when you bought LNG or UNG, you were simply rolling yourself up that curve I showed you from March 2023. You were simply rolling from one contract to the next. Every single time you roll, you lose a little bit of money. And it might be only a couple of percent, but that adds up over time. And when you're rolling every month, it adds up and compounds very, very quickly. So when you buy UNG, you're not buying physical gas. You're not buying gas at 2 or 225. You're buying futures, and then every month that contract, that ETF is rolling to the next month. Now, I'm not going to sit here and tell you that UNG is never a good trade. In fact, it can be a very good trade. We've recommended it in the service, CT Trader Commodities, multiple times profitably. Also, sometimes we've lost money on it. We've been stopped out, but on balance, we've made money in that fund. The trick is you have to understand what you're trading, right? If you're trading a short-term pop in natural gas, for example, you think that the price of natural gas might pop based on a cold snap or something of that nature, or you look at the Commodity Futures Trading Commission data and see that traders are very short natural gas, and you think there could be a quick pop over the next few weeks, you can buy a fund like UNG and be fine. In some less volatile commodities, like for example, even oil, right, which have less of a seasonal variation in prices, you can also buy a fund like USO, which tracks West Texas Intermediate, and make money. But what we were seeking to trade back in early February had nothing to do with the short-term price of natural gas. It had to do with the shape of the curve, the fact that we expected that over time, U.S. natural gas prices would recover, and that would benefit companies that produce and sell natural gas, like Southwestern Energy. Now, I want to talk a little bit specifics about Southwestern Energy itself. Southwestern Energy, as I said, is a U.S. natural gas producer. It produces from 2 regions of the U.S. I just threw up a map here on your screen. This is a map from the Energy Information Administration showing the major shale fields in the United States, some of the major shale fields in the United States. And I want you to look at that green area, Appalachia, right? That is an area at places like West Virginia, Pennsylvania, and Ohio. This is an area known as the Marcellus Shale. Now, the Marcellus Shale is a natural gas field that is the lowest cost natural gas field in the United States. Now, a high quality producer in this region can produce gas from the Marcellus Shale profitably, even with prices around 225 to 240 or so a million BTUs, depending on the exact producer. The other natural gas shale field I want you to look at goes south, and there's sort of an orange square in East Texas and Louisiana, right? And Northwest Louisiana that's marked Haynesville Shale. The Haynesville Shale is also a natural gas field in the United States. It's a very big natural gas field. It's not quite as big as the Marcellus, and it's not quite as cheap to produce. The Haynesville, most producers there probably need prices to average somewhere around 3 to 325 a million BTUs. And what I do every quarter, by the way, is I take the results from all of the producers I cover. They're about around 30 or so U.S. Oil and gas producers, or oil or gas producers that I cover. And I'll look at them and I'll look at their results and I'll look at their costs particularly. And one of the things I like to do is calculate sort of a cash flow break-even cost. In other words, if gas prices are trading around 250, can they still produce free cash flow? And so I know what the price structure is like for many of these producers. And I can tell you that most of the Haynesville producers need prices around 3 and up to make money. Now, Southwestern Energy produces from both of the, one more thing about the Haynesville. Notice where it's located there, right? So the Appalachia fields in West Virginia and Pennsylvania are located a long way, an awful long way from the US Gulf Coast. So gas that's produced there has to be piped down to the US Gulf Coast if, for example, you want to export it in the form of liquefied natural gas. Or if you want to, say, ship it to pipeline to a state like Florida where gas is needed to produce electricity. It has to be moved by a pipeline. So there are elevated transportation costs. And you've probably heard or seen these reports on TV of people protesting these pipelines coming out of Appalachia to move gas out of that region, tying themselves to trees and all kind of craziness like that. And one of the problems with that, of course, is that it makes it expensive and potentially impossible to build a lot of additional pipeline capacity from Appalachia. So the producers that are there, high quality producers, already have pipeline capacity to handle their production, already have contracted firm capacity to handle their production. But building new pipelines to, say, grow their production rapidly would be difficult. The Haynesville Shale, though, look where it is. It's in Louisiana and Texas, which, mainly Louisiana in this case, in terms of production. This is the heart of the LNG export corridor. So a lot of the producers in the Haynesville sell most of their production to Gulf Coast liquefied export terminals. So these companies are looking to sell their gas for export. To be honest with you, not just export, but in their infinite wisdom, some states in the Northeast would not allow pipelines to bring gas from the Marcellus Shale, which is located literally on their doorstep, to their markets. And so they're actually importing, if you will, LNG from the US Gulf Coast up the coast or other places around the world. So the LNG export corridor is very important. Prices are very high there, and transportation costs from the Haynesville are very low. So I think the Haynesville is going to be a key region for producers who want to export natural gas. They're going to get good prices there because price of gas outside the United States is much higher than it is here in the United States. So they can sell their gas into these markets at attractive prices. So Southwestern has operations in both the Haynesville and the Marcellus. Their Haynesville production breaks even a little over 3. Their Marcellus production is in the low 2s. So overall, they can make free cash flow at prices around $275 to $285, roughly. It depends a little bit from quarter to quarter, how much they're spending in capital, but that's a good marker at this time. And also back in February, March, when we recommended this trade. So you have a company that has exposure to both of these attractive regions, and they have a low cost of production within each of these plays and overall. Yet still, back in February when we recommended this trade and all spring, the price of natural gas was a lot lower than that break-even cost in that sort of $375, $385 range, right? So why would we recommend a producer that's producing gas and selling it at a price below their break-even price? They're losing money, right? No, that's not how it works. Again, when a producer produces natural gas and sells it, it's not that they don't sell all their production in the month of March 2023 or April 2023. They sell their production over the course of a year. So though they're selling some production at March 2023 prices at depressed levels, they're also selling, as I showed you on that curve, some production for delivery in December or January at $3.50 or $4, so well above their break-even price. In addition, Southwestern is a very savvy company. Their hedging policy is to hedge a lot of their gas production ahead of time. So in March and April of this year, say the end of the first quarter and the beginning of the second quarter of 2023, even though the spot price of natural gas, the front month futures, were very depressed, Southwestern had already locked in their prices for their production in late 2022 when the futures were much higher prices, were offered much higher prices. So when I first looked at this trade back in February, they were about 60% of their 2023 production was hedged with a floor price of $3 a million BTUs and higher. So the beauty of that is that even if gas prices were depressed for much of the year, most of their production was being sold at prices that were much higher because they'd hedged it at attractive prices months before when gas prices were much higher, futures prices were much higher. So our view was that Southwestern Energy was depressed, and I'll show you here, the next slide I have for you is actually a chart of Southwestern Energy, not today, but back on February 6th when we recommended this trade. This is just the closing price of Southwestern Energy is that blue line. The gray line is the 200-day moving average, and the orange line is the 100-day moving average. And so you can see this stock traded up over $9, around $9.50 a share in June, July of 2022. And at the time we recommended it was trading just a little bit over 5. I believe our actual entry point was around 506. So we recommended buying 1,000 shares at that time. And as you can see, the price was very depressed when we recommended buying it. And our view was twofold. And again, when I look at trading in a stock like SWN, you have to take into account both fundamental factors, which I just kind of reviewed, and technical factors. And we felt that the price on the fundamental side, essentially, we felt the price of natural gas of SWN was depressed because investors were looking at that front month price of natural gas, even though Southwestern Energy had very little exposure to that depressed front month price of natural gas. And we felt that with their hedging policy of hedging 60% of their production, say a year out, right? Gradually over time, layering in hedges, they were probably already locking in prices for their production in late this year and early next year at much higher prices, $3.50, even $4 a million BTUs, which did turn out to be the case. And so we felt that they were going to be able to preserve free cash flow a lot more than the market expected because of these hedges, and that as prices rose, as the futures rose, the sentiment towards the stock would improve, and investors would start to look forward to 2024 and the fact that they were locking in much more attractive gas prices where they're able to generate literally billions of dollars in free cash flow over time. So we felt that there was a fundamental disconnect between their actual exposure to front month gas prices and what the market was, how the market was pricing them. The second thing is, if you look at this chart, and I know this is just a line chart, I use the Bloomberg terminal. You can probably see it over my left shoulder here to actually do charting, but those charts don't show up very well on slides. So I'm just showing you the basics here. And what you can see is that the stock was into support. If you go back to late 2022 and early 2023, late 2021 and early 2022, SWN was trading in that sort of $4.50 to $5 range. So there's a lot of support there, technical support. And so we felt that SWN buying it around 5 and then maybe even adding to it if it dipped a little bit into the low 4s would be a good entry point. And if it broke down below 440 or so, we could take the loss and move on. We might be wrong on the trade. It's very important to have that idea, that risk management discipline. So that's where we entered the trade. And I want to show you how this thing progressed over time. Now, as I said, this chart here shows a chart of Southwestern Energy on September 1st. Now, I took this chart back to October of 2022, so this is before we got in, right? All the way up through September 1st of this year. Now, as I said, we entered the trade in early September or early February at a price of a little over 5. It did dip down to around 460, 470 was the closing low. But by September 1st, we jumped all the way back up to a little under $7 a share for SWN stock. And as I said, we initially recommended 1,000 shares. On September 1st, I recommended selling 250 of those shares for a nice gain. I believe it was around 34% or so all in on the exact date and time that we recommended getting out. Now, why did I do that? Again, we enter trades on fundamental and technical reasons. I usually exit trades based on technical reasons, chart reasons. And in this case, you can see that the stock had run up a lot, had a nice rally from early June trading around 475 all the way up to nearly 7, right, by early September. So a very good summer. And it was into resistance, the trading range, and you can see it with this black arrow I've marked here, from the fall of 2022. So we were up 30-some%. The stock was looking a little overdone, overcooked on the upside. We thought it might be risk of a pullback, maybe down to as far as $6 or so, right? And we were into resistance. So we took 1/4 of the position, just 250 shares of SWN, off the table for a nice profit. Let's roll forward a bit more. Now, this is a chart on the 18th of October, which is actually the day we recommended selling the remaining 750 shares of SWN at prices near $7.50 a share. Now, why did we recommend selling the rest of our position SWN at that price? Well, I want you to, this chart is actually a chart I took from Bloomberg. The first black arrow you see on the left-hand side of the chart is our entry point, right? The second black arrow moving to the right on September 1st is our exit point for the first 250 shares. And that third black arrow is our exit point for the last 750 shares, which we got a profit, as I said, around 45% overall. So why did we exit on the 18th? Well, you can see right before that, the stock ran up a lot. And that was based on a Reuters report, Reuters news service. In the afternoon, they came out with a report saying that Chesapeake Energy, which is another bigger natural gas producer in the United States, with operations in the same two fields, right? The Marcellus Shale of Appalachia and the Haynesville Shale of Louisiana, very close acreage to where SWN is located, therefore an obvious fit, those two companies together, was considering the acquisition of SWN. Now, I heard at the time, and based on my valuation work, I felt that the stock could be worth around $8 a share in an acquisition from Chesapeake, but that it might take a while before Chesapeake actually acquired SWN. I still think the deal makes a ton of sense, and frankly, I think ultimately it will happen. Probably will be an all-stock deal where Chesapeake acquires Southwestern, but I thought it could take some time to put together. At the same time, SWN immediately popped up over $7.50, not that far from where I thought their offer might come in, a little over $8. And I want you to look at that bottom pane of the chart. This is an indicator called Relative Strength Index, or RSI. It's an indicator of overbought and oversold conditions in a stock. So readings above 70 indicate a stock that is overbought. I look at it on two different forms. One is a 9-day relative strength. The other is a 14-day relative strength. This chart shows the 14-day relative strength. And you can see that it popped up over 70 just as this takeover rumor came out. Now, when something like that happens, my view is when you have an overbought stock based on a takeover rumor, not an actual takeover where we actually have some real numbers to hang our hat on, but just a takeover rumor, it's time to book some gains. And I told the readers at the time, hey, if SWM were to pull back over the next few days, or at least sort of trade sideways for a few days, I would be quite likely to get back into it or recommend getting back into a position SWN. But I thought it was time to book gains because even if Chesapeake had come out with a takeover, I thought they would probably only offer somewhere around $8 and only in stock, which wasn't that much upside. And if they didn't come out with a takeover offer in the next week or two, I thought the stock could pull back under $7 and we would be giving back a nice chunk of a profit. So I recommended taking a little money off the table. And this is how we like to trade in CT Trader Commodities. We like to get into and out of stocks over time in multiple entry points. Now I'll show you here, this is the chart of SWN today. And you can see that it did actually pop up over 750, but since then it's actually pulled back a bit. And it's pulled back, as I said, mainly I think because Chesapeake hasn't yet come out with an offer. Southwestern and Chesapeake both had good quarterly earnings. That price of natural gas has pulled back a bit on the front month, but as I showed you on that last slide, the longer term prices still look very good. Southwestern is still breaking even at around the same prices they were back in February. They've cut their capital spending, and I think they're actually outperforming their production and cost estimates. So I think going into 2024, they're in excellent shape. I would not be at all surprised to see Chesapeake ultimately come out with a deal. And whereas I didn't think it was great buying it at $7.50 or above, right, back in mid-October, I do think at prices down here closer to $7, there is upside in Southwestern. So what we recommended last week was buying 500 shares of Southwestern, not 1,000, but 500 at current prices. And our view is that if it were to pull back, you can see there that 50 and 100-day moving average, this sort of purple pink line and the green line, if you will. That's pretty good support level for Southwestern. If it were to pull back to that area, we might look to add to our exposure to Southwestern. We use position size recommendations in the service to help control risk. So if we think that we want to get into a stock because we feel it may go up imminently, but we also think there's a chance it could pull back a bit first, we'll take a small position to start and add to it if it does dip, right? So that we get a better average price. In addition, if the stock goes the other way, the wrong way, if you will, we can get out for a smaller loss because we kept the position small on the small side. It means that we can give a trade a little bit more room to work out, if you will. So we bought it a little over 7, and if it pulled back to 650 or so, and we had 1,000 shares, that would be a pretty big loss for the service. So 500 shares, it's very manageable. So that's how we look at it. Now, I know from experience and talking to a lot of our readers and members, some trade more than 40 or 50,000, which is about what you would need to take every position in the service. The maximum amount of capital we've had committed in the service for all the trades, right, at one time is around $40,000. So if I know some readers commit that much or more, some multiples of that, but a lot of our readers like to use less capital than that. So they like to trade with $25,000 or $20,000 in capital. If that's the case, simply take the position sizes we recommend and cut them in half. And again, this one trade generated us a gain of $2,150. So even a half-size trade on say a $20,000 or $25,000 trading portfolio, it's a very nice gain, and it's real money in the service. So with that gives you an idea of the kind of trade we do. But Southwestern is not the only trade we've taken. In fact, we've had a good run of trades, especially lately. On October 20th, we closed a trade in the Bloomberg Ultra Oil ETF, symbol there is UCO. That was a total profit of a little over $1,900 at our recommended position size. The capital committed to that trade was around $6,500, a maximum capital committed to that trade. We also booked a 38% gain on uranium mining company Cameco. That was back in very early in September. We took a gain on a trade there. That position, the maximum capital committed to that trade was less than $5,000. We have a trade outstanding in gold now, which is profitable. I think it's a little bit late to get in on that now, but we are looking to potentially take another trade in the gold market. As I said, we also have an agricultural trade out now and a fertilizer producer in the service right now. So if you're interested in this type of trading, one thing that I've decided to do is I've decided to open up the service to a risk-free trial offer, a 60-day risk-free trial offer. And we're actually doing that at the lowest price we've ever offered for CT Trader Commodities. Right now, if you click the button below this video, or you give our customer service manager, Sherry, a call, her name is Sherry, a call, and tell her you watched this video with Elliot on it, at the toll-free number you see below my sort of disembodied head here, then she can take care of you as well. And the service is $999 a year. Normally we're going to be charging $1,500 a year for this service, but it's $999 a year for this service right now. Try the service for the next 60 days, 2 full months. That takes you into early 2024. See the trades we're making in the service in real time. Participate in our monthly Q&A online. Basically get to take advantage of the service in every way that a paid and full member would take advantage of it. If you're not convinced that it's a great service, that it's useful for you, if you don't think that trading is right for you or this type of trading isn't right for you after 60 days, just give us a call or shoot us an email and cancel your subscription for a full refund. No questions asked. I guarantee it. So I urge you to give it a try if you have any interest level in this whatsoever. And again, if you don't, frankly, even if you invest sort of half our position size and you don't think that after a year of this type of trading, you're going to more than generate the subscription cost of the service, simply call us, cancel your subscription for a full refund, no questions asked. So I hope you enjoyed that. I hope you found it useful. It really sprung out of a lot of questions I was receiving at the Orlando Money Show last week. If you have any questions for me, again, you just drop me an email and I'll try to get back to you, or maybe I'll create another video and cover some other topics. So thanks again for listening. I hope to greet many of you as new subscribers to the CT Commodities Trader service here in just the next few minutes. Thanks again.